Of this session is the project analysis. We have with us Dr. Pramod Kumar, Senior Scientist, Division of Agriculture Economics, IRI. In this session, we will be covering what is the project, features and different types of the projects, how project and policy are related, then how to identify the project cost and benefit, what is the difference between the economic analysis and financial. I welcome you, Dr. Saab.
Thank
and
you.
Please explain what is the project.
Okay, thank you, Dr. Praveen. So let me define as to what is project. So project is agricultural project is an investment activity in which financial resources are expended to create capital assets. So in this, the capital asset is created which produces benefits over a long period of time. And under projects, we have two types of capital expenditure. Two types of expenditure is incurred in any project. One is the production expenditure, and the second is the investment activity. So under the production expenditure, as we know, these are the expenditures on fertilizer, pesticides, etc., which are spent in a single crop season. So these type of expenditures are spent in a single crop season. As against this, we have another set of investment activity which gives returns over a long period of time. The returns are very small, but it keeps on, as against the investment, but it keeps on giving the returns over a long period of time. So such investment activity needs a separate tool to analyze such projects. So that is why the project analysis course provides us the tools and techniques by which we can analyze such investment activities which are long term in nature, which persist and gives returns and benefits over a long period of time. So coming to the various types of projects, what are the various types of project which are existing, which can be classified into various types? And there are basically 5 groups. It can be classified into 5 groups. One is the projects on technological innovations. So many times the technological innovations, they take place, and that is converted and implemented in terms of a project. Say for example, superior varieties of seeds and planting materials. So for this, we had high yielding variety program during the 1960s, when the short duration and short dwarf varieties of rice and wheat, they came up. So these were taken up as a project, and these are called as the projects on technological innovations. The second is projects on broadening physical resource base. So certain projects could be there which broaden the physical resource base which is available in the country. Say for example, the water is made available through taking up of projects like construction of dams, canals. Similarly, we have programs which improve the land resources like watershed or salinity related programs are there. So such projects are called as the broadening of physical resources. They broaden the physical, they increase the resource base which is available in the country, which can be utilized by the farmers to produce higher and higher returns. Then the third one is the projects on improvement of disadvantaged groups. So certain projects are implemented to alleviate the poverty or to improve the status of the downtrodden people. Say for example, projects on land settlement or land reform projects, under which the land is transferred from the persons who are not having land. So such programs are classified as the improvement of disadvantaged groups. Then the fourth is the projects on post-harvest handling and distribution. So certain projects are taken up wherein the post-harvest handling and distribution is improved in the country. The institutions which implement the programs, so such type of programs are also there. So these are the various 5 types of programs or projects which are the projects could be classified into. Then let us now look into the features of a project. What are the basic features of a project? So the project should have a smaller size which is easily manageable. It should be economically, technically and administratively sound and manageable. Then the second is the projects are considered and evaluated, or it should be considered and evaluated at all levels of planning and implementation. So right from the bottom to the top level, it should be scrutinized or evaluated. The project should be evaluated. Then all the projects, whether of public or private sector, should be analyzed. Whether it is a public project or a private sector project, it should be analyzed. Both should be analyzed before implementation and after implementation as well. Then the projects of agricultural projects are biological in nature, and therefore they are different from the industrial projects, and they should be treated differently because they involve a lot of risk and uncertainty. The production is not defined, whether the production would, whatever is thought of, would really take place. So similarly, there are cost uncertainties. So these uncertainties are built into the agricultural projects, and they should be treated separately as against the industrial projects. So these are the various features of project. So there is it also occurs as to a question occurs as to whether plan and project, what is the relationship between plan and project, whether the plan is more important or the project is more important. So let us first see the relationship between plan and project. So do the plans, they require projects. So sound plan needs knowledge of existing and potential projects. So sound plan cannot be prepared unless we have the knowledge of existing and potential projects. Then the extent of realism of plans depends on the rate at which the good projects can be planned, designed, built and brought to capacity operation. So how realistic is the plan, or how realistic it depends on the type of projects, how good is the project, how fast we can generate projects or create projects, plan projects, design and implement them. Then input-output relationship can also be found from the investment and output trends in industrialized countries. So we can, if we want to take into the consideration what will be the input-output, suppose a new project is to be implemented, then what should be the input-output? Do we know the input-output? So for that we can look into the industrialized countries where they had been already implemented, maybe 10 or a decade or two before. So the input-output relationship could be taken from there and then used for analysis and to prepare a sound project. So plan definitely needs a good project. So there is a dependence between the plan and project. Now let us know or try to understand what are the aspects in project preparation, what things should be taken into consideration while preparing a project. So there are various conditions which needs to be seen while preparing a project. We should take into consideration the technical aspect, the institutional aspect, the organizational, what should be the organization of the project preparation or implementation. So that need to be clearly considered and analyzed. The managerial capacity of the people the beneficiaries, the implementers, whether they are sound enough or not, or they need to be improved. So that need to be taken care while preparing a project or while undertaking a project. If that is not there, then it should be improved. Then social institutions, whether they accept the particular product which will be developed from the project or not. So that needs to be taken into consideration. Then commercial aspect, the financial and economic aspect also need to be considered while preparing a project, and need to be, so that the project which is prepared is sound enough. Now let us understand the project cycle as to what is because project is cyclical in nature. It follows a definite pattern and results into, and it has a definite cycle. So let us know what are the various stages of project through which a project passes on. So the various stages are the identification of a project. We need to identify the project first, and then second stage is what kind of project could be taken up, or what kind of project could be there. So that is the identification stage. Second is the preparation and analysis. We need to thoroughly prepare and analyze the project. If we select that if we screen that these are the 5 projects which can be taken up, we need to prepare a broad detailed plan of a project. Then it has to be analyzed at that stage itself. Then at third stage, the appraisal takes place. So the project which has been prepared is analyzed, and then the implementation is done. Then evaluation, and the evaluation leads to identification of new areas or new avenues on which the project could be taken up, and that completes the cycle. So this is how the project moves from one phase to another phase and completes a cycle. So let us look at each of the phases of project one by one. So the first one is the identification phase, wherein we find the potential projects, where we will find the projects which can be taken up. So the various sources from which the project could be found is the technical specialists or the local leaders could help us in identifying the project. What project could be implemented for will be suitable for a particular area or for a particular reason. That we can get from the technical specialists, either the engineers or the technocrats. They could help us in identifying the project. Second is the local leaders. We can interact with the local leaders as to what kind of projects, what kind of problems they are facing, so which can help us in proposing or preparing a project. Second is the extending existing projects. Whatever existing projects are or ongoing projects are there, so that can be extended further, or we can find out that can give us the leads as to what kind of new projects could be there, and we can extend those existing projects, refine, or whatever problems the existing projects are facing, that can be refined and modified, and they can be extended. Third is the economic development plan of the country. So the plan of the country itself, we have a huge plan is prepared every 5 years. So now we are preparing the 12th 5-year plan. So this plan document itself speaks of as to what kind of projects should be taken up. So we can get a very good clue as to what kind of projects should be taken up, and that will be always in line with the thought of the country. So that is this is a very good source of identification of project. Fourth is the sector survey of current situation. Many times the sector surveys are taken up by the government institutes, the committees who conducts the sector specific survey. Suppose a particular sector is facing a problem, say for example agriculture sector. Within the agriculture sector, if the rain-fed region is facing some problem, so rain-fed region, there is a specific survey is undertaken to find out what are the existing problems and what solutions could be there. So these kind of sector surveys also give us a very good clue as to what kind of projects should be there. Second phase is the preparation of project, preparation and analysis of the project. So prepare the project, consider all aspects of project preparation. So whatever the aspects were dealt in, so those aspects need to be considered while preparing the project. Take up feasibility study. So one should take up the feasibility study, whether the project would be feasible or not. So preliminary feasibility study should be taken up right at the preparation stage itself. Then detailed planning and analysis begins at this stage itself. Then we also undertake soil survey, hydrological survey, cropping pattern if it is an agricultural oriented project. So these are the kind of surveys which are basic surveys which are taken up so as to find out the feasibility, technical feasibility, commercial feasibility, etc. And also it gives us the input output ratio which is used for feasibility analysis and for plan preparation. Then usually for this phase the time taken is 1 to 2 years of time is taken by any person who is preparing a project, and then the time taken here improves the efficiency of the project, and that leads to smooth implementation. So more and more time should be given at this stage. The third stage is the appraisal stage, wherein once the project has been prepared and it has been analyzed by the person who is preparing the project, then it is analyzed or appraised by independent body. Appraisal committee is there which appraises the project, and if the proposal is sound, investment may proceed. And if there are some flaws, that is indicated, and one tries to alter the plan and develop a new plan. Many times the World Bank projects, the projects which are submitted to the World Bank for its funding, they send separate mission to appraise the projects, and that is how the project appraisal takes place, which is usually done by an independent appraisal body. Then it is followed by the implementation. If the project is sound enough, then it is taken up for implementation, and this is the most crucial phase, because any project, however sound it is the success of the project depends how well it is implemented, because many times there are certain conditions or certain things which are changes as the time progresses, and it is the implementer who should think as to what changes need to be brought in at every step, or every day he has to think what changes need to be brought in so as to implement the project most in a smooth manner and most efficient manner. So that is why this stage is considered as one of the most crucial stages. Then it is followed by the evaluation phase, and after that we have different kinds of under this we have different kinds of approaches which can be utilized for evaluation of a project. One is the with and without approach. The second is the before and after approach. So there are two basic approaches for evaluation of a project. One is with the project and without the project. Second is the before and after project. In with and without project, the evaluation of cost and benefits is done with the project, and it is compared with the situation, that is the what would be the cost and benefit when the project is not there, and the difference between the two gives us the net benefit which will be arising as a result of project. So this is widely used, and the second approach is the before and after approach. This particular approach has basic limitation that it does not take into consideration what changes would be there in the production even if the project is not there. So this is one of the basic limitation. Otherwise this is also used for project evaluation, and this approach gives slightly higher, the net benefit which will be arising from this approach would be slightly higher, on a higher side. So that caution has to be taken up. But these are the two basic approaches of project evaluation. Now let us also look at as to what are the, when we are evaluating a project, we need to identify the cost and benefits. So one of the basic facts or for project appraisal is that we need to identify what would be the sources of cost, what would be the various types of benefits, and we need to put value to that one. So identifying cost and benefit is one of the most important. And out of the cost and benefits, we have two types. One is the tangible cost and benefit. The other set of cost and benefit from a project which will come out from a project which is related with the project is the intangible cost and benefits. So here we are looking at the tangible cost and benefits. So these are the cost and benefits that can be valued in monetary terms. So any cost and benefit which can be valued in monetary term is called as the tangible cost and benefit. And the various types of tangible cost and benefits are the physical costs, the labor, in any particular project, what would be the manpower needed and what would be the wages for those manpower. So these can be easily identified, and that is why it is coming as under the tangible cost and benefit. Similarly, the physical cost, what will be the amount of cement needed, mortar needed, or the steel needed, or various inputs. If it is agricultural sector, the amount of seed, fertilizer, etc. would be needed. So these are the various physical costs which are involved in a particular project, which can be the amount as well as the quantity, and the value could be easily determined. Similarly, we have the land, the contingency allowance. In many of the projects, the contingency allowance is to be given so that to take care of the increase in cost and increase in cost or the value of various cost and benefits. So for that, the contingency allowance has to be put into the project while preparing the project. How the taxes need to be taken up, the debt services, and the sunk cost. So these are the various types of tangible costs of agricultural projects which needs to be considered while preparing taking the feasibility study. Similarly, we have the various set of tangible benefits. So what are the type of benefits which can come from a project? So these are the list of projects. One is the increase in production. Any project could lead to increase in production. So what is the amount of increase in production that needs to be assessed, and that forms the core of the benefit which is coming out from the project. Similarly, certain kind of projects are there which lead to quality improvement. So suppose a project is there which leads to increase in quality of produce which is coming out. Say for example, in case of dairy sector, if certain project is taken up, implemented, it may lead to improvement in the quality of milk which is coming out, which may be so that also needs to be accounted for under the benefit section. Benefit side of the project. Changes in time of sale. Certain projects may change the time of sale of the produce. Suppose warehouse cold storage structures are created under a particular project, then that leads to storage of the produce. The farmers in the region, they store in the cold storage and they sell the produce later at a later date. So this leads to change in time of sale. So that also leads to appreciation in the price which the farmers are receiving. So we need to account for the benefit which is emanating from such projects and account for in the agricultural project as a benefit. Similarly, change in location of sale. Suppose rural roads are created which leads to the farmer is able to sell the produce at a far off place in a big market wherein the value realization is much higher. So that is how the benefit has to be accounted for. Changes in product form, like in case of processing, certain projects they lead to better grading and processing of the agricultural produce. Cost reduction through mechanization. If mechanization projects are there, like say for tractorization or tube well, buying of tube well, subsidy is being provided to the farmers to buy tube well or buy tractors. So that leads to mechanization, or so mechanization leads to efficient utilization of resources. Timeliness of the process is done very quickly. So that leads to increase in production and the quality produce comes, and so that is how the benefits from these projects, though it may be difficult, but has to be accounted and taken into project evaluation. So these are the various type of benefits which emanate from various projects, and that needs to be accounted in project evaluation. Similarly, we have intangible cost and benefits. So certain cost and benefits are difficult to evaluate the worthwhileness of those, so but they need to be also carefully identified and taken into consideration while evaluating a project. So for example, such kind of intangible cost and benefits, the examples of such are the creation of new job opportunities. So certain projects may lead to creation of better job opportunities, more number of people get employed from a reason. So that is a social benefit which is coming. They get the income, it creates a source of income for the families. Similarly, certain projects they improve the health of the people. Certain projects also reduce the infant mortality. Then projects also lead to national integration. So these are the type of benefits which are emanating, which are difficult or put a value to that, but certain system has to be found out or devised to account for and taken into consideration while evaluating the project. Then while evaluating a project, we also come across there are certain cost and benefits which are called as the secondary cost and benefits. So let us know as to what is this secondary cost and benefit and what should be done with this type of cost and benefit. So the in agricultural project lead to creation of benefits and costs outside the project area. So certain the projects they lead to creation of cost and benefits outside the project area, which is not meant for the areas for which the project wasn't meant for. There also it leads to creation of it may lead to creation of cost, addition of cost, or it may give benefit to those areas. So say for example, the technological spillover or technological externalities. So say for example, a high yielding variety of seed is propagated in a particular village, but that also leads to adoption of those varieties in the neighboring villages. So that is what is called as the technological spillover, and that is a benefit of the project which has been taken up in a particular small village, but it has generated benefits outside the project area also. So the multiplier effects leading to additional investment, increased consumption of goods and services as a result of the consumption multiplier. So these need to be accounted for while and taken into consideration while evaluating the project. Next is the now let us understand what are the various types of analysis which is possible. So first one is the farm investment analysis. So under the what is this farm investment analysis? It is the assessment of financial performance of the project. So the farm investment analysis deals with the financial performance of the project. The objectives of the financial analysis are to know the financial impact of project entities. What will be the financial impact on the beneficiaries of the project? To assess the efficiency of the resource use, whether the resources are efficiently utilized or not, the land, labor, capital, they are efficiently utilized or not as a result of the a particular project which has been taken up, or it leads to underutilization or overutilization. So that needs to be assessed. And then to assess the incentives to project entities, whether the project entities are getting sufficient incentive to implement the project. Then to provide provision of a sound financial plan. So that also leads to sound financial planning of the project, and to better efficiently manage the project, to coordinate the financial contributions. So these are the benefits of financial analysis. Then the next type of analysis which is possible, which tool which is utilized for the analysis project evaluation, is the farm budgeting. So this is another important tool of of analysis of project. Under the farm budget, the basic purpose of farm budget is to estimate the incremental net benefit arising from on the farm as a result of the project. What is the incremental benefit which is coming from the project on the farm? So for this we calculate the net benefit without the project and then the net benefit with the project, and the differential gives us the incremental net benefit which is coming up from the project. And farm budgeting is a very important tool to evaluate the benefit from the project. Now there are various tools of financial analysis of agribusiness firms. So among the various tools, the balance sheet is there, then the income statement, and the cost cash flow analysis. So these are the various tools of financial analysis of agribusiness firm. So let us know these tools individually because they are very important tools. So the balance sheet is the one. It shows the firm's financial position, that is as regards the assets, the capital and the liabilities of the firm at a specific date. At a specific date, what is the amount of asset the firm has, the capital it has, and the liabilities it is owning. So these are prepared at a point of time at a particular date, and usually it is the 31st March of any financial year which is for which the financial balance sheet is prepared for a particular firm. And the assets are how the balance sheet looks like is, on one side we have the assets, the other side we have the liabilities and the equity. So this is how the balance sheet is prepared and it looks like. And from this balance sheet various financial and physical ratios are calculated, which are used for financial analysis of the firm. So on asset side we have the current assets, fixed assets and the other type of assets. On liabilities side we have the current liabilities, which are short-term loans, the long-term liabilities, which are medium and long-term loans, and the owner's equity. That is, the owner's equity is nothing but the claims against the assets of the enterprise by the owner. So how much the owner has a claim on the firm, that is what is the owner's equity. And these three together, they balance the balance sheet, the accounts of the firm. The next type of financial tool which is used for financial analysis is the income statement, and this is otherwise also called as a profit and loss statement. And this consists of how does it look like is, it consists of the revenue stream, and then it also shows the expenses, and then the profit, that is the revenue minus expenses. So these are the three things which are or can be observed on an income statement of any particular firm. It is prepared for one accounting period, as against the balance sheet which is prepared at a point of time. This is prepared for accounting period, that is whole of the year is taken as a period for which the income statement reflects, and this shows the revenue, the expenses and the profit which is accruing to a particular firm during the whole of the financial year. Then the third very important tool is the cash flow statement. And the cash flow statement is otherwise also called as the sources and uses of funds statement, and the source of measuring the total flow of financial resources into and out of an enterprise during an accounting period. So this gives us, during the whole of accounting period or 1 year period or 2 years period, what are the sources from which the cash is coming in, and the various items against which the resources are going out or the cash is going out. So these are the various two sources which it shows, the cash flow shows, and it is used for projecting the total cash flow into future. So this cash flow can also be used to project as to what will be the cash flow in future. If a project is taken up, what will be the changes in the various inputs and outflow and inflow in the cash for a particular firm, and how much benefits would be generated in future. So that can also be prepared using the cash flow statement, and this is usually prepared using the inputs which are derived from the balance sheet and the income statement. Now let us know as to what are the various financial ratios which can be computed from out of these three tools of financial analysis. So this financial ratios help us in assessing the financial health of the enterprise, and the various ratios which can be computed are the efficiency ratio, the income ratio, credit worthiness ratio. So these are the various ratios which can be computed for financial analysis. Under the efficiency ratio, we have the inventory turnover ratio, which is the cost of goods sold over the inventory. So what is the proportion of inventory which has been sold? So that is what is reflected by inventory turnover ratio, and higher is this, the better it is, because more amount of goods are sold off by the firm and the cash is generated. On the other side, we have the operating ratio, which is the operating expenses to revenue. So it's the ratio of operating expenses. What is the operating expenses to revenue which is generated, and this should increase over a period of time to show that the firm is doing well. So the operating ratio should increase over a period of time. Next is the income ratios. So this among this income ratio, we have the returns on sales, then is the returns on equity, and returns on assets. So returns on sales is nothing but the net income to, it is a ratio of net income to revenue. So what is the net income to the total revenue which is generated? So what is the proportion of net income to the total revenue which is generated? So this should be higher and higher in order to show the financial efficiency of the firm. Returns on equity, that is the net income to equity, that is the own funds. So as a proportion of own fund, what is the amount of profit which is generated? So this should be also be higher and higher. Returns on equity should be higher for to show that the firm is doing very well. Returns on asset, that is the operating income to total asset. What is the amount of total asset which this operating income constitutes? So that is what is reflected by returns on assets. Then we can also find out credit worthiness ratios from the three tools which we have. So under this, we have the current ratio, that is the current assets to current liabilities, which is a very important tool to assess what is the amount of current assets to current liabilities. And then is the debt to equity ratio, that is the long-term liabilities to long-term liabilities plus equity. So these two ratios can be derived, which shows the credit worthiness of a firm. Higher is these ratios, better is the credit worthiness of the firm, and the bankers could easily lend to such firms who are having higher current ratio, because they have a very good amount of assets which can be utilized in the event of eventualities to repay the loans. Then let us look at the various tools which are available for evaluation of the project. What are the tools which are available for evaluation of the project? So first thing which we should know for evaluation of the project is the time value of money, as to what is the value of money, and how we can take into consideration the time value of money in evaluation of cost stream and the benefit stream, and to evaluate the project. So under this time value of money, as we know that future value of present money can be estimated through the formula compounding method, that is A amount is equal to principal into 1 plus I to the power t. And similarly, there is another one which is called as the discounting present value of future money. Suppose if we get returns after 5 years, so if we want to estimate its worthwhileness in the present day, so present value of future money could also be estimated through this technique, and this is called as the discounting technique. And the present worth is given as the principal, the amount which we will be receiving after 5 years, divided by 1 plus I to the power 2 t, and where I is the interest rate or the discount rate, and the t is the time period. So this is a very important tool which is utilized, which will be using in the various tools which we have for project analysis. So various tools of project evaluation, or the various project evaluation techniques which are available with us, is it could be classified into two. One is the undiscounted measures, and the second set of techniques are called as the discounted measures. The undiscounted measures, we have three types. One is the ranking by inspection, the second is the payback period, third is the proceeds per unit of outlay. So ranking by inspection, under this the project is evaluated based on the by mere inspection. The committee of 3 or 4 people, they sit and evaluate the project, various projects, set of projects. Suppose 5 projects have been given for evaluation and to rank, and only 1 or 2 of them need to be taken up for implementation. So the committee sits, the committee of experts, they sit and they rank by merely inspection. And under this, what we try to see is the amount of cost and the amount of benefit. as to what is the amount of cost involved and the amount of benefit which will be generated from the project. So based on the one criteria is based on the cost, second is how quickly the returns will be coming from the project. So based on these two criteria, the ranking by inspection is done by the evaluators. Then second is the payback period. This is one of the most important tool which is utilized by the evaluators for evaluating the projects, and this is called as the payback period, because any investor would like to know as to how quickly his investment will come back. So that is what is meant by payback period, whether the investment which is made would come back to the investor in 2 years time or 3 years time or 5 years time, because the more quickly the investment comes back is the better is the project. So that is what is the payback period. The third is the proceeds per unit of outlay. So this is merely as to per rupee of investment how much total output would be coming, or how much income would be generated. So this is what is the proceeds per unit of outlay. So total benefit will be which will be coming from the project is added up, and it is divided by the total amount of investment which will be needed, and that gives the proceeds per unit of outlay. But one of the basic drawbacks with this undiscounted measures is that it doesn't take into consideration the time value of money. What is because the benefit which will be coming after 5 years is not same as the amount of money which will be coming out. Will not have the same value as of today, and that is what is one of the basic drawbacks with this undiscounted measure. The second set of measures of project evaluation is the discounted measures. The advantage of these measures is that they take into consideration the time value of money. Under this we have three types. One is the net present worth, the benefit cost ratio, and the internal rate of returns. So these are the basic techniques which are available for evaluation of the project. So let us look at these projects, because these are very important. Let us look at them in one by one. So the first one is the net present worth. Net present worth is given by this formula which is given here. So in first component of this formula consists of negative sign, which is the investment, the amount of total investment which is going in. So that is given a negative sign. Then the second component consists of the various benefits which will be coming from the project, because the projects by nature, as we know, they generate benefits over a long period of time, and they also involve small cost over a long period of time. So the net benefit is discounted. Each year's benefit is discounted, and they are summed up under the second component. And the third component consists of certain projects also have generate the salvage value of the assets which are created under the project. So the value of those assets could also be taken up, considered while evaluating the project, and that is the third component. That is, discounted value of those assets are taken into consideration as benefit, and the summation of all these three terms gives the net present value of the project. Second is the benefit cost ratio. This is nothing but the summation of the total benefits, the discounted values of benefits which will be coming up generated from the project, divided by the summation of the total cost which is involved, the discounted value of the cost which will be involved in the taking up the project. So the ratio of the two gives us the benefit cost ratio, and it is usually it should be more than 1 for the project to be. The decision criteria is that it should be more than 1, and higher is this ratio, better is the project's ranking. Then and in case of net present worth, it is the value which is generated is in terms of rupees or dollars, and more is the net present worth, higher is the ranking of a particular project, and lesser is the amount of the net present worth, then the lower is the ranking of that particular project. Then the third and the important tool is the internal rate of return, and this is the rate of return which equates the net present worth of cash flows over a period of the life of the investment equal to 0. So if the net present worth is equal to 0, that rate of return is considered as the internal rate of return of the project. And similarly, for this, the evaluation of or computation of the internal rate of return, we take it is the same as that of net present worth formula, which is equal to 0. And if the rate of return or the discount rate is varied, and the rate of return which makes the NPV equal to 0, that rate of return becomes the internal rate of return of the firm. And the decision criteria is that this rate of discount rate or internal rate of return should be higher than the cost of the capital, or the bank rate which is available, which is usually taken for evaluation of the projects. So if it is higher than the bank rate, then the project is considered as feasible.
Dr. Pramod Kumar, in agriculture basically, we can't predict or we can't measure the prices or many things in agriculture with percentage. In that condition, what we should do? How we can measure the cost or how we can appraise the project?
Thank you. So this is one of the basic problems with the agricultural projects, because as against the industrial projects, these projects have a lot of uncertainties built into it. So in order to take into consideration these uncertainties, there are certain built-in mechanisms which can be utilized for evaluating the agricultural projects, and certain cares has to be taken up. So looking at the first one is the sensitivity analysis is one tool which is utilized for evaluation of the projects, which is done for the evaluation of the projects. So after the but these also sensitivity analysis is done after these three tools of project evaluation has been taken up, that is the NPV, BC ratio and IRR. After that we go in for the sensitivity analysis. So under the sensitivity analysis, because we know that the cost and benefits, they may not be realized as we predict, so what we try to do in under sensitivity analysis is one of the elements, either the cost or the benefit stream, we try to vary or change, and try to see what will be the change in the outcome, what will be the NPV, what will be the BC ratio, what will be the, suppose the price is there, so price of labor is taken as say 50 rupees, if that price in future is expected to rise to 60 rupees or 70 rupees, so only that price is changed, and we try to see what will be the change in the NPV, BC ratio, IRR, and if it is feasible, then we go ahead. So similarly, there are certain other methods of allowing for uncertainties, like discount rates. We may vary the discount rate, considering that in future the rate of interest would rise, so discount rate could be kept at higher level. Then social opportunity cost of capital or social time preference could be taken up. So these are another methods of taking into consideration the uncertainties.
Okay, I thank you, Dr. Pramod Kumar, for giving or explaining what is the project, how project and plan are related, what are the different types of project, then how we can access or how can appraisal the different type of project. Oh, thank you very much. Thank you all the audience or all the students for taking.